Okay, guys. So good morning, and what a week we have in store. Definitely. Well, I think we'll certainly at the start of the week. Obviously, on paper, things look amazing in terms of news flow, in terms of significant events. I mean, on paper, it really does look like, the best week of the year in theory. Whether it turns out to be like that, of course, time will tell, but massive events ahead of us from all angles, not just huge economic data, but massive monetary policy events. We've got OPEC meetings, we've got the IMF deciding on the yuan. It's such a we've got Yellen, of course, as well. I'll talk about the schedule shortly, but yeah, huge week ahead. It will really definitely set the tone, certainly for the rest of the year. I know there's only 4 weeks left, but really could set the tone for much of Q1 2016. It's literally that important. So exciting times. Now let's look around markets. What's happening? Last week was it depends where you're looking on the equity space. Let me just change the DAX to a daily chart. So we've got our S&P and DAX on the same daily time setting here. And actually no, forget that. Let's go weekly, just to have a look at the week, because it's quite interesting, the difference. Check out the S&P's week last week. I'll just zoom in a bit here. Then last week was almost a perfect doji. The percentage change on the week, 0.06%. Whereas for the DAX, we climbed again, breaking the downward trend line, up 1.7%. So notable divergence, and we're getting a continuation of the theme here on the S&P. We'll see this week. But I've been talking about the fact that over the last 6 months, we're now getting a pattern of lower highs for this market. The market having trended higher for pretty much 6 years straight. Looks like it's showing signs of fatigue, and a 6-month sort of triple set of lower highs. Again, last week, this seems to be playing out, despite the fact Europe pushed on last week, despite the fact we had, generally speaking, an ECB stimulus expectation rally in Europe. It didn't feed through to the US pushing higher. So the US was flat in amongst a strong Europe, sign of the times, and I think has could well shape the behavior or the correlation between these two assets for months and months ahead. But notably the S&P underperforming last week and staying flat. Now let's talk about Europe, and let's talk about what happened amongst these European assets, and let's talk about whether or not it is possible for Draghi to now even match expectations. I think expectations ahead of Thursday's ECB meeting have just gone off the rational scale, and I think it's going to be very difficult for Draghi to even meet expectations, let alone beat them, like he did at the start of the year when he rolled out a monster QE program. Last week then, and a continuation of the theme, look at my European assets. So top right, we've got the DAX, bottom left, we've got the euro dollar, bottom middle, the Bund. All of them moved in favor of the ECB doing more last week. So we had the Bund, notably on Friday, breaking out above the October high. However, we did close back on that level. So we did not get a close above the October high. So although we broke it intraday, we closed actually just shy of that level. So a very bullish week, although they just failed to get that close above the October high, the bulls. But still, Bund's higher. The euro was lower. We had a double bottom for the week at 105.69. Which, if I just make this chart a bit bigger and zoom, then this was this was just shy of the April low, and then of course we got the March low at 104.74, which was the low of the year. But certainly the euro staying under pressure. So euro weakness, European bond and equity strength, and this is all ahead of Super Mario on Wednesday. So what do markets now actually expect Draghi to do, and is it possible for him to match expectations? So there's several kind of policy tools that they can use, and here's basically markets now expecting Draghi to use all tools to their absolute maximum. I mean, I was reading the kind of Deutsche view this morning, and I just think it's insane. I just don't think the ECB can do all of this. What Deutsche think is that they reckon they're going to get an interest rate cut both to the deposit rate and the main refi rate. They reckon they're going to cut deposit rate by between 14 to 20 basis points. So let's say it's 20. That would take the deposit rate down to minus 0.4%. They then expect the ECB to extend the quantitative easing program by 6 months. They also expect the ECB to increase the amount of monthly purchases by 10 to 15 billion. So taking it from 60 billion currently per month to 75 billion potentially. They think they're going to expand the pool of assets available for purchase by buying stuff like municipal bonds. They also think, as if that wasn't enough, they think they're going to remove the yield floor from the asset purchase program, because at the moment they've got a rule. They can't buy bonds that yield below the deposit rate. So Deutsche reckon they're going to cut rates, extend the quantitative easing program, and speed it up by increasing monthly purchases. They reckon they're going to buy more risky stuff like municipal bonds, and they're going to scrap the deposit rate barrier to the asset purchase program. I think that's just like fantasy world. That's like a 5-year-old kid writing his Christmas list, and you know, wanting a Ferrari and wanting a return trip to the moon, and you know, this kind of stuff. I just think we've got carried away. I don't think Draghi's got a chance here of delivering this. Now, data this morning also kind of makes this a little bit difficult. What we do have is, don't forget, we've got a backdrop of a strong set of numbers from Europe last week. Data is inching higher. We've got cycle highs for things like the composite PMIs. You know, we had strong data from Germany. And actually, just talking about German data, so this morning we've had inflation numbers. And if I just show you, actually, let's start with the calendar for today, because we've got regional inflation numbers all through the morning from Germany. These are November numbers. And so we've already had Saxony at 8 o'clock. This is how Germany do it. We get all the different regions reporting inflation numbers individually, culminating at 1 o'clock with the kind of headline national German inflation number. These are preliminary November figures. I'll talk about the Saxony ones in a sec. Let's just look at what else we've got today. Other than these inflation numbers from Germany, we've got some mortgage approval and money supply figures from the UK at 9:30. Italian numbers on the inflation side as well at 10 and then 11. And in the US, the main focus will be on Chicago PMI and pending home sales. So important day for inflation in the Eurozone's biggest economy. And this certainly carries significance when the ECB sit round their table on Thursday and have this meeting. And what are the Germans going to be saying? Because, of course, they are the biggest economy. They carry a huge amount of clout in that monetary policy setting environment. And if we've got strong German data, and more importantly, if we've got strong German inflation, then you might get the Germans arguing against, well, any more stimulus, never mind the huge amount of different stimulative factors that the markets are expecting. So if we look at German inflation here, then this is the chart out over the last 12 months. So it's been a bit of a choppy ride, of course. But the important thing is we hit 0 in September. We bounced to 0.3 in October. And if Saxony's got anything to go by, then we're looking at a plus 0.4% print for German inflation, which would put it at a 6-month high. Now, I know this is still ridiculously low in the grand scheme of things, and we should be at 2%. But, you know, most of the fact we're this low, of course, is commodity price collapses. So 0.4% annualized is what Saxony just delivered. We've got plenty of other regions still to report, so we'll see. But I mean, what we're expecting the national reading to be is 0.4%. And if you get Saxony reporting above expectations, there's a chance we might get a beat on this. Let's say it goes to 0.5%, then, you know, this is 6-month highs for inflation. You know, Eurozone composite PMI coming in at whatever it was last week at like a 2-3 year high. And, you know, can the ECB be aggressive, you know, in amongst this impressive set of economic data? Never mind, can they deliver stimulus? Can they get anywhere near what markets are expecting? So I do feel sorry for Draghi when you get market expectations ramped up to just off the rational scale. You know, there's just nothing you can do to match those. So I think we're in for an interesting week. Real risk. We've got markets that are over optimistic here. So that's the ECB. I mean, we have got a phenomenal week. If I just kind of point towards some of the highlights, and they are plenty. I mean, I would say today's session is probably the least significant, but that, you know, we still have this German inflation print. We got Chicago PMI. We've got the IMF reporting on the yuan, but really, it's a strong day every single day. Like tomorrow, we'll have all the manufacturing PMI numbers from around the world. So we'll get Chinese and European and US manufacturing PMIs, as well as the ISM manufacturing number. As always, day one of the month is manufacturing day. Wednesday, we'll get the European, or the Eurozone, I should say, inflation print, having had the German numbers this morning. We'll also get the ADP employment report, which is the warm-up for Friday's non-farm payrolls, of course. Get the Fed's beige book on Thursday. On Wednesday, you also get Janet Yellen. She's got a 2-day speech, Wednesday and Thursday this week. So this is really the last time we're going to hear from Yellen before the big meeting on December the 16th. So it's an important week for the Fed, not only because Yellen's going to give us her last guidance, forward guidance, if you like, but also we get the final payrolls number of the year, and the final payrolls number before the key meeting, where we're still expecting the Fed to hike. But back to Thursday, we'll get all the services PMI numbers first from China and Asia and Europe, before then moving into, of course, the big event, which is the ECB press conference. We've got a hell of a lot of US data as well, though, in amongst that. But obviously the ECB conference will definitely take center stage. But we've got ISM non-manufacturing, we've got jobless claims, factory orders out of the US on Thursday as well. And then Friday, we have the OPEC meeting. We have German data. But then, of course, the big one will be the non-farm payrolls number, where we're currently expecting somewhere around 200,000. So, massive week. Just touching on OPEC there, of course, you know, very, very interesting meeting. This will be in Vienna on Friday. We'll have probably headline risk throughout the week on this. This is typically what happens. You're going to get OPEC oil ministers from all over the place just delivering their sort of personal thoughts ahead of the meeting. As it stands, we're expecting no change to production, but there's plenty of OPEC nations that are hurting. And if you get monetary policy going the way that we think in December, i.e. the ECB being aggressively stimulative and the Fed hiking, well then this thing on the bottom left here, the euro versus the US dollar, is going to continue to track lower. We're going to break the March lows, and who knows? I mean, if Draghi can possibly match expectations and the Fed hike, then parity's not far away. And this means dollar strength, of course, which is only going to continue to put the commodity space under a huge amount of pressure. So, there is a risk that oil continues to come under downside pressure with the August low here on the January contract, right on the $40 handle. Any downside pressure into year end, of course, is only going to make matters even worse for these oil producing nations that have been under a huge amount of fiscal pressure for the entire of 2015. So there's a lot of desperate OPEC members desperately trying to get Saudi to perhaps change their view. But as it stands, we don't expect them to. We expect output to stay unchanged. And so headline risk throughout the week. Currently, right now, we're kind of sitting here, back below $42. We've got a bit of a level around 41.20. We got the low from last week, which is at $40.40, and then you got the August low below that. Big level at $40, of course. Okay, so if the dollar does continue to strengthen, and look, the euro dollar's been testing the double bottom from last week. We had a brief moment this morning where it looked like we were getting reversals of this sort of ECB trade, where we had equities moving lower, we had bunds under pressure, we had the euro dollar up on its highs. But actually, if we just now zoom into shorter time frames, let's go on our charts here across these charts I'm showing you. Since then we've had a bit of a reversal of that initial theme, where we've now got the euro dollar back down, looking at trying to test the lows from overnight. Yeah, that key double bottom from last week then, around about 105.70. Got the DAX actually now new highs for the day, but a kind of key double top for the week for the DAX, up around 11,360. You got the Bund, which was under quite a decent amount of pressure this morning on the downside. We hit Thursday's low at 158.15, and a pretty sharp bounce off there. So we had a bit of a nervous patch, a nervous spell at the open this morning, with I think people just looking at these ECB expectations and just thinking there's just no way. Then you got the German sort of regional numbers. We're just getting Bavaria report now, actually. Just seeing, so on Bavaria, they're reporting their month-on-month CPI number at 0, which is below the previous reading of plus 0.2. The annualized number is coming in line at plus 0.5%. So we're just getting some more German regional numbers here. Just on the data earlier on this morning, we had some retail sales figures from Germany that actually disappointed. Month-on-month retail sales at minus 0.4% when we had expected plus 0.4. We had a bit of dovish commentary from the Bank of England earlier, which has just tipped cable down to briefly make a new low. We're just flirting with the sort of 150 handle at the moment for cable. So cable under a little bit of pressure, and this is down below the November the 6th lows. So just from cable, that is this morning, that's a new, 7-month low on cable as we move below the 6th of November low. So that's important technically. So sterling under a bit of pressure after some Bank of England dovishness. We've had some mixed numbers from Germany with weak retail sales, but then you're getting the inflation numbers come in. Perhaps, it's mixed, I guess, as well, but certainly Saxony above expectations. You've got a huge week ahead and I'm nervous the ECB aren't going to be able to deliver. But at the moment, that brief bit of nervousness off the European Open has stabilized, and here we are an hour after the cash opens, and you got equities back on the front foot, and Europe has been so strong. That equity move into the end of the week last week was very powerful, based on ECB expectations. So we'll see if there's any more legs in it this morning. But I'm just my worry for this week is that the ECB just simply cannot deliver what markets expect. Okay, that's it for now. Plenty to think about, plenty to navigate through. This really is going to be one of the most pivotal weeks of the year. Pivotal weeks, or I don't want to say the decade, but I don't want to big it up too much, but it literally could be. So exciting times. All right, enjoy the